Hello, everybody. Welcome back to another video brought to you by Value Drivers. Today, we're going to be talking about a pretty sensitive topic nowadays, debt, and particularly the consumer edition of debt. So, what this means to everyday people like you and me. Definitionally, debt is typically something that is owed, or you are in a state of obligation to repay someone if you are in debt. Generally, this is for something you have received, whether it's some sort of interest or tangible good or something of another matter. Typically, this is just going to be one party owing another party money. This can be in the form of a person owing a company money, a person owing another person money, or a person owing some sort of entity money. The main point I want to drive here is debt comes in many shapes and sizes. It's very rare that you'll get a one size fits all approach to anything in life. Debt is particularly sensitive to this. There are many types of consumer debt, and typically it'll be a combination of these items, not just one or the other outside of the either ors we're going to go through now. So you typically have either secured or unsecured debt, where you either have some sort of capital or some sort of pledge behind it or collateral. On the flip side, the unsecured side is where you don't have any capital. It's just primarily based on your historical performance through something like a credit score, where it weighs your historical means of paying back other debts or obligations on time. Then typically it will either be revolving or installment based. So revolving is where a line of credit is provided, something like a credit card, where you can pay down the balance and then continue to use the debt within the same statement period. The flip side is installment debt is where payments are done on a schedule over a specific period of time, which is known at the inception of the loan. Then you would either have a fixed rate or a variable rate on this debt. Fixed rate debt is where you would have a consistent rate on the loan throughout its entire life, and variable rate is where the rate would change in accordance with the market interest rate. Then you would either have short term or long term debt. Short term is essentially the life of the debt being 1 year or less, and long term is the life of it being over 1 year. Lastly, on this list, you would either have callable or non callable. Callable debt means the issuer of the loan has the right to redeem or require you to pay it ahead of schedule. Non callable debt means the issuer cannot require you to pay it before the maturity date. This is typically something you would see with bonds. Very rare you would see this in circumstances of consumer transactions. Now, jumping into the detailed slides here, you have something like secured debt, where it's backed by an asset used as collateral. Now you can see it's got a strong backing there. It's heavily backed, as shown by the image. Now this could be a car, house, some sort of other asset-backed loan. Typically the lender would place a lien or a claim of ownership on the title, then fronts you the money to buy the asset. If you ultimately fail to make those payments, the lender can repossess the asset. Secured debt is considered less risky due to the underlying asset being backed in the loan, and these would typically have lower interest rates compared to an unsecured debt or an unbacked debt. In the event of bankruptcy, secured lenders are always the ones who are paid back first or made whole first before unsecured lenders. Then we have unsecured debt. These are instances where the loans are not collateralized or there is no underlying asset. So this would be like a personal loan or a credit card. As you can see on the image, it is unbacked, a weak backing, or no backing, realistically. These are seen as much higher risk due to there being no underlying asset, and typically would have a higher interest rate to compensate the higher risk. Unsecured debt are typically associated with more aggressive repayment offers as well. So you have collection agencies and other people who will sell your debt at a discount to companies who would specialize in collecting. Then you have revolving debt versus installment debt. Revolving debt is constantly available. You can pay it down, drive it up, pay it down, do that over and over again. Something like a credit card or a line of credit, like a home equity line of credit. As you can see by the image on the bottom right, it's kind of like a revolving door. You can just keep spinning all year long. On the flip side, you have installment debt. This is where there are set parameters and a lump sum with fixed repayment schedules. This would be the typical method for consumer loans for cars, homes, and appliances. Fixed rate versus variable rate debt. Fixed rate debt has interest rates that remain consistent throughout the entire life of the loan. So this would be favored when interest is perceived to go up in the future. Variable rate debt, on the other hand, is where the interest rate can change based on the benchmark, which is going to be the market, such as an index. So this would be favored if you feel like interest rates are going to be going down in the future. Between short term and long term debt, this is really just timing. Is it 1 year or less, or longer than 1 year? Short term would be 1 year or less, and long term would be longer than 1 year. Between callable and non callable debt, the biggest difference here is whether or not there is a right to require full repayment before the maturity date. This is typically seen on something like a bond. Very rare that a consumer like you and I would have to deal with this. Typically, the non callable debt is something that we're familiar with, where it cannot be redeemed before the maturity date. What that means is the company that we take out the loan with can't require us to pay up front the day after we take out the loan. Key takeaways from this is really there's a large number and variation or types of consumer debt. We should really take caution to read the fine print before agreeing to any sort of debt, making sure we understand what we're up against. Do research and ensure that the type of debt is right for you and that you get to the right debt that is going to help you grow, not the type of debt that is going to stop you. I want to draw your attention to the image on the right. This is the types of debt on average for US households by debt type. I encourage you to be better than the average. I want you to have lower than the average on every single one of these if possible. That's all I've got for today. I hope this was insightful for you, especially as a consumer getting to learn more about consumer debt. Please feel free to leave a comment for anything else you'd like me to cover. More than happy to explore any topics. Be sure to like, comment, and subscribe. It helps out a lot. Thank you so much. Catch you later.